Hi, I'm Morningstar Markets Editor Jeremy Glazer, and welcome to Top Picks from Morningstar Strategists. We're going to get some great ideas for your portfolio. Just as a reminder, you can ask questions to our strategist in the box to the right of your player. I'd like to introduce our panelists today. First, we have Josh Peters. He's the he's the editor of Morningstar DividendInvestor, also the director of Equity Income Strategy. We have Russ Kinnel. He's our director of Mutual Fund Research and editor of Morningstar FundInvestor. Matt Coffina, editor of Morningstar StockInvestor. And finally, Sam Lee. He's editor of Morningstar ETFInvestor. Gentlemen, thanks for joining me today.
Good to be here.
Good to be here.
So we've gotten a slew of questions about income and where you can find income in today's environment. So I'm going to start with you, Josh. Obviously, your portfolios are very focused on finding dividend income. What kind of opportunities are you seeing in dividend-paying stocks right now?
Well, I think the most important thing I want to emphasize right now is quality. I mean, we've had a big run-up, big recovery in the stock markets over the last couple of years. Valuations across the board, when you're looking kind of on a historic, bottoms-up type of framework, don't really look all that attractive. But I like to go back to what Ben Graham said and many of his pronouncements in addition to the intelligent investor. And he really warned against the idea that you take second-rate securities to try to juice your return. There's certainly the risk that you could overpay for a high-quality security, but he pointed out the bigger risk is that you buy secondary securities at fair weather prices, and then you go on to have disappointing results. So even though there's not a whole lot of out-and-out bargains, which is obviously the kind of environment that I would prefer. A name like Philip Morris International in this environment trading a little bit below our fair value estimate, yielding around 4%. Great wide-moat franchise. I like that name. A couple of names that are still in buy territory for my purposes. Wells Fargo recently raised its dividend for its second time this year, showing a great commitment to getting that dividend back up and running after having had to cut it a few years ago. Great franchise there. General Electric, another name that the dividend's continuing to recover from the crash, still yields over 3%. There are names out there, but it isn't the kind of environment where you can say, well, I like energy across the board, or I don't want to own any utility stocks. It's really a matter of bottoms-up stock picking and focusing on quality.
Is this the case then when individual stocks might make more sense than a basket of stocks? Sam, do you see any dividend ETFs that maybe are attractive right now?
I agree with Josh in that there's really nothing that sector-wide is attractive. But if I had to go with a dividend-paying stock ETF, it would be either Vanguard Dividend Appreciation, VIG, and dovetailing with Josh's point, it's really a basket of high-quality dividend-paying stocks that have grown their dividends 10 years straight. So it weeds out all the junky companies, and you can really be sure that those dividends are going to stay around for a long time.
But how about dividend growth? What are your expectations for the prospect of seeing these kind of high quality stocks being able to keep growing out that payout, or corporate profits already at a level where they're not going to be able to keep growing them and then grow that distribution?
Well, I think we're seeing some positive signs on that front, that the payout ratio, the proportion of earnings in the S&P 500 that is paid out as dividends, is starting to creep up. A couple of years ago, we actually hit an all-time low of about 29–30%. We're making some progress there. As we see more companies initiating new dividends, raising small dividends into more meaningful ones, I think that creates more opportunities for income investors. But for me, really, I want the companies that have already put that great track record out there. And a company like Johnson & Johnson, has raised its dividend every year for many decades. The growth rate has certainly slowed from where it was a few years ago, but this is not an emerging opportunity. This is a well-established company capable of maintaining that payout through thick and thin, continuing to raise it through thick and thin. Those are the names I really want to gravitate to, rather than necessarily, leaping on the newest company that just started paying a dividend.
Russ, on the open-end side, are there any kind of dividend-focused managers that are doing a good job in this environment? How should investors like to invest, in those vehicles think about this?
Yeah, I think moving up for yield in equities is a little better than in bonds, where that's really been squeezed dry. So I think funds like Vanguard Dividend Growth, one that Christine Benz recommends all the time. It's got a decent yield, but it's also focused on companies that can grow their dividends, and that means they have to have a pretty clean balance sheet and pretty good business. So that's a good discipline. You could even, in emerging markets, you could move to a fund like Matthews Asia Dividend as a way to get a little yield where maybe you weren't able to get yield before. And in that case, you're actually dialing down the risk, because dividend-paying stocks in Asia are generally going to be a little less risky. So those are two of the options I like.
So we have a question from Dan who asks if it's a good time to be adding to MLPs, master limited partnerships, is with a time horizon of forever. Do those stocks look attractive?
Well, I think that there's relatively few opportunities among MLPs right now. Two names that I do like are Energy Transfer Equity. It's one that Josh also owns in one of his portfolios. It's actually our largest position in the Hair portfolio. And they're really at an inflection point, I think, where it's been very difficult for them to grow their distribution over the last several years, but they've really simplified their business model and reoriented around some new areas where they should be able to re-accelerate the growth going forward. Our analyst is actually looking for double-digit distribution growth over the next 5 years on top of 4.5 or 5% current yield. Another name that I have in the Hair would be Enterprise Products Partners. Again, the yield is only 4 to 5%. But it's a very steady grower, really taking advantage of all the drilling activity that's happening here in North America. And our analyst thinks that they can probably grow the distribution 5 to 6% a year. You take a 4% yield, growing 6% a year indefinitely, and you get a pretty attractive total return.
So there's recently been some new structured products that hold MLPs because there's some potential tax issues with holding individual MLPs. Can we talk a little bit about what those tax issues might be, and do these new structured exchange traded products help mitigate any of those problems? Sam?
So there are really two big structured products. I don't really like the term structured product because it actually implies more of a something that a bank creates. So there's AMLP, which is the Alps Alerian MLP ETF, and unfortunately, what that does is it uses an open-end company form to buy MLPs, and since more than 25% of its portfolio is in MLPs, it gets taxed as a corporation. So that ETF has suffered some massive tax drag. So it's lagged its index by over 5% annualized. I think in that case, you're way better off just buying the MLPs yourself, or I hate to say this, but you can buy the exchange-traded note. So there's the JP Morgan Alerian MLP, ETN, AMJ. What JP Morgan has done is they've basically issued a bond that says that I am going to provide the yield of the MLP index and also the total, the price return of the MLP index minus an 85 basis point fee. So ETNs get taxed at a very, very favorable rate. So you get kind of stock-like taxation, not on the income, but on the price. And that can really mitigate some of the tax hassles of owning a big basket of MLPs.
And just one last MLP question for you. We had a question from a user that was asking how would the to see what kind of distribution, what would you expect with the units to happen in a rising interest rate environment? Would that have any impact on MLPs in terms of financing or anything that could impact their business?
I think the most important thing you want to look for is growth, and that goes for MLPs as well as ordinary stocks and REITs. That if the dividend isn't growing, or in the case of an MLP, the distribution isn't growing, then you're kind of left with a junk bond that's never going to mature and might not be real high quality if there's not the business to support dividend increases or distribution increases, and you're probably going to have more interest rate sensitivity even if that income stream remains stable. So I look to the kind of names that Matt mentioned, Energy Transfer Equity. Enterprise is a name I haven't owned in the past, but certainly a partnership I have a great deal of admiration for, as well as my largest holding. It's a little expensive right now, trading $50, $51, but Magellan Midstream Partners, another double-digit distribution growth story. As long as they can keep that distribution growing quickly, and I think they've got the business model and the management to do that, then I don't think it's going to just trade like a bond. If interest rates go up, you're not going to see these tumble out of bed say an AT&T with a very low dividend growth rate, a little more exposed, some regulated utilities more exposed, REITs I think very exposed to higher interest rates. If you've got growth there to compensate, then it's going to behave I think a little bit more like a stock. And if the interest rates are rising because the economy is doing better, then that's a little bit of a tailwind for these companies too.
You mentioned REITs. We've had quite a few questions about both equity and mortgage REITs as a potential way, to get more income. Russ, when you look at some of the real estate funds, do you see those as, being attractive places for people to look for income right now, or are there, some pitfalls that investors need to be aware of?
Yeah, I think it's an okay place. I mean, definitely REITs have, like anything else that's got a yield, REITs are not cheap, and so you definitely want to be cautious. You could go with a fund like Third Avenue Real Estate, which will also buy real estate operating companies instead of just REITs. It's going to be more volatile, but at least it's not working an area that's worked over as much as that. I also feel like a fund like PIMCO Inflation Response Multi-Asset, ticker PIRMX or PDRMX, and what I like there is they combine a lot of different inflation strategies. So REITs and TIPS, emerging market local currency, commodities, all in one package, which is nice because if inflation does come back, you don't know exactly which areas it's going to show up in most.
And then, Josh, I want to ask you about your favorite topic, mortgage REITs, which I know is a area that investors are enticed by that high yield.
Yes,
are there any risks associated with that?
Yes, tongue digging through the side of my cheek as say favorite topic. I mean, these securities obviously are out there providing very high yields, in some cases double-digit yields. Can loop business development companies, BDCs, in with those, as well as some other specialty financials. I mean, here's a case that just it's so obvious that you don't get a super high yield, a double-digit yield on anything in this environment unless you're taking a lot of risk. And we've been in an era of pretty calm financial markets here over the last couple of years. Financing terms are relatively easy now. Interest rates are pretty low. There's been some tailwinds for these sort of financial models, but they don't earn these returns without taking a lot of risk. It might be credit risk, it might be liquidity risk, it might be interest rate risk, it might be yield curve risk. One of the biggest names, Annaly Capital Management, has a pretty good reputation. They managed to get through the crash okay, but it's a play on the shape of the yield curve. And if you don't know what that means and you can't forecast it, then you don't know how the dividend is going to change over time. But you can look back over the last couple of years, see dividend moves up and down, up and down. It's not going to provide you with that steady level of income over the course of a cycle. I really regard them as just too speculative to play a role in a serious income-focused long-term portfolio.
Okay, let's shift gears a little bit and start talking about fixed income. Bonds were a lot of what we talked about this morning. We had a dedicated bond panel from Ariel Investments. Kelly Babinski said we're in a bond bubble. Does this mean that there aren't any great fixed income funds out there for an investor who's maybe worried about rising rates? What kind of bond funds might make sense for that kind of investor?
Yeah, well, the one I mentioned kind of plays on that somewhat, the PIMCO Inflation Response Multi-Asset, though it's not a pure bond fund. So there's no bond funds that have a lot on offer. I think you can go with a emerging market fund like PIMCO Emerging Local Bond. You can go with a fund like Loomis Sales Global Bond, and you'll get some yield, but they're high risk.
So what about on the exchange-traded space? We have a bond now. You have a PIMCO, a total return ETF. Are there other fixed income ETFs that maybe investors should get better acquainted with?
So one thing that I do not like about a lot of bond ETFs, especially the ones that are more speculative, thinner slices of the market, is that they allow investors to make tactical or strategic bets themselves that they'd probably be better off outsourcing to a professional investor. So my advice is actually pretty boring. Just own PIMCO Total Return ETF, BOND, because most investors don't realize that when they're owning X slice of junk bonds, a Y slice of emerging markets bonds, they're actually playing the role of a strategic bond manager themselves. And it's not really clear whether most investors have an edge in doing that. So I would say that just simply outsourcing your bond picks to a professional investor is probably the best course for most, the vast majority of individual investors. I'm not a fan of broad-based indexing because a lot of the indexes are based on market cap weightings, and market cap weightings are supposed to represent the average investor. But the average investor in this world is not, mom and pop. It's, insurance companies that are forced by regulations to hedge their liabilities, sovereign wealth funds, central banks that need to adhere to some kind of a currency stability mandates. So just owning a big slug of treasuries that these broad-based index ETFs own is, in my opinion, not an optimal course of action.
So how about on the global bond side? If you wanted access to emerging market debt, an area that's been hot in terms of investor flows, what would be some options there? And is it advisable, to have a dedicated exposure to emerging market debt?
I would say I think you can, but you got to keep it small because it is high risk. So if you do that, like a fund like PIMCO Emerging Local Bond, run by Michael Gomez, is a decent fund that gives you some currency diversification. But keep it small because those are high risk, and like everything else with the yield, it's been chased down, and the risks have grown as the yields have come down.
So I guess taking maybe a step back, we have a question from a viewer who's asking, do you feel that investing in stocks is less risky than investing in bonds right now?
Personally, I think that's the case. Even if you're looking for income, I think you can find higher yields from some high-quality stocks, and those yields or those dividends are also going to grow over time. Versus buying, a 10-year Treasury at a 2% yield that's not going to grow over time, and you're taking on all of that inflation risk or the risk of higher rates down the road. A name that comes to mind would be Paychex, for example. That's a company that's the stock's yielding 4%. The payout ratio is relatively high, but the cash flows are so stable that we think the dividend is quite safe. And even better, it would actually do even better in a rising interest rate environment. There's an aspect of the business where they take the payrolls from the employer before they have to actually pay them out to the employee. And they invest that money on their own behalf. In the meantime, the low interest rate environment has really hurt that stream of income for them. So you get the same yield, but you're actually leveraged to higher rates.
You mentioned inflation there. What about, how are you thinking about inflation? Do you expect to see more inflation, Sam? And do you think that there's any kind of products, like a TIPS product, that might, make sense in this environment?
I'm not very confident in my macroeconomic forecasting abilities. My crystal ball is a little broken there. But I would say historically, it's been the case that when countries run up a lot of debt, massive amounts of debt. So people worry about the U.S. is that, the rich world's debt, the U.K. and the Eurozone. But we've been through those periods before. Immediately after World War II, the U.S. actually had a higher debt to GDP ratio, same with the U.K. And what we did wasn't necessarily massive inflationary periods. Is actually a slow chipping away of our debts. So just let inflation run a few percentage points more than whatever interest rates are, the cash yield is, and over a decade or so, you'll go a long way of eliminating those debts. So just using history as my guide, I don't expect us to enter into some kind of massive inflationary death spiral, but I do, I think it's reasonable to believe that we're going to be entering in a world of financial repression. And for that, there are already mutual funds that do that. So again, but if you had to do it, if you wanted to do it yourself, I would say emerging markets bonds are probably a decent bet to slightly overweight, especially local currency bonds. So Wisdom Tree Emerging Markets Local Currency Bond, ELD, might be a reasonable investment. But again, as I mentioned before, if you're going to buy these ETFs yourself and you're going to set a certain allocation, you are playing the role of an active manager. So if you don't have an edge in forecasting this type of thing, you're better off outsourcing it. And you can get professional investment help for very, very low cost with a mutual fund or an actively managed ETF.
When you say financial repression, you mean the Federal Reserve's policies of keeping rates extremely low, which makes it very challenging for savers, to find kind of a good safe yield.
Yes.
So we have a question from David, who asks that he now has a portfolio that's 50% in bonds and the rest in dividend stocks. He says he's not going to need the money for over 10 years. Does it make sense to take some of that fixed income part of his portfolio and move it into dividend stocks, or is that taking on too much risk in a portfolio?
It's not a great set of choices. I mean, you'd love to be able to say, you know, dividend-paying stocks across the board are cheap and the best thing since sliced bread. Well, I happen to think that they are the best thing since sliced bread because they do play this dual role of providing a lot of current income, like fixed income does, but also giving you that hedge against inflation and capital appreciation and real income growth. You know, in this environment, I think you have to characterize it in terms of relative choices. And if you think of the stock market having run up here as being not, you know, 5 stars or 4 stars, but maybe 3 stars or 2 stars, well, then you think about bonds, long-term bonds as being 1 star. And you're actually improving the risk and return characteristics, I think, of a portfolio by shifting more into equities for income at this point and leaving the treasuries behind. There's certainly other things that you can do with fixed income, but as far as treasuries go, I mean, it's very hard to find, I think, a good reason to want to own those for the long haul. You know, some people will say, well, they tamp down on the volatility a little bit, but if they're going to lose you money or they're not going to generate any real return, you know, you can just use cash, you know, as a sandbag. So, you know, I don't think that this, you know, on a relative basis, you've done very, very well probably in bonds here over a very long number of years. Yeah, dividend-paying stocks have come back from the levels of the crash, but I think there's still a good risk-reward trade-off to be had at this point.
So you mentioned potentially moving into stocks, and that's a nice transition to our next topic, which is about getting back into the market. You know, we've heard from a number of investors that have been on the sidelines either from the financial crisis or from the recent highs. They're sitting on a lot of cash. They don't know what to do. You know, Matt, what would you say to that investor who, you know, is sitting on a big cash pile? You know, should they just throw everything into equities today and, you know, kind of hope for the best?
So I think the big lesson that we should have learned over the last 5 years is that you can't panic even when the market's down 50%. You know, the guidance that I would give is that we have to have an investment approach that's really grounded in intrinsic value. The truth of the matter is the value of real businesses, you know, the Exxon Mobils, Johnson & Johnsons of the world, especially those high-quality companies, the value of those companies didn't fall 50% during the crash, and they didn't double in the last 5 years either. The reality is that the intrinsic value was much more stable over that time. If you look back at late 2008, at the peak of the financial crisis, we had more than 800 5-star stocks. The average stock was trading at maybe 45% discount to our fair value estimate. Looking at the market today, we think that the average stock is more like fairly valued, and it's much harder to come by 5-star stocks. You know, that said, I think that I would still very much prefer to own stocks over the long run to the alternatives of either bonds or cash. There's certainly a lot worse things in a fairly valued market. If all of our forecasts were exactly correct, I would expect a fairly valued market to return about 10% a year over the very long run. Obviously, you're going to have a lot of ups and downs in the meantime, but that still will, you know, kick the pants of bonds or cash.
I would add too, just you know, I think you need to build a plan and maybe take 6 months or so to get to those target allocations, and maybe that way you'll be able to survive the next crisis. But also think about what led you to sell everything and get into cash. Was it that you're watching business news 8 hours a day or something? I think a lot of people, the cable news really kind of built up their fears, whatever, it's a 24-hour news cycle, and find out what that was and try and correct for that as well so that you don't panic the next time, but build a plan and get there.
Exactly. I was actually going to say something similar, and especially a good financial advisor, especially one that's low cost, fee only. Because if you are the type of person who panicked out and sold everything, that is a much bigger risk than any investment out there. It doesn't matter if you own stocks or bonds or whatever, dividend-paying stocks. The biggest threat to your retirement is yourself. And so the first thing you got to attack is, you know, how am I making mistakes and how can I prevent that from happening again? And a lot of times that's having a financial advisor who's actually grounded in the principles of long-term investing, low-cost investing, diversification, and who also provides reasonable expectations of what you can do in this market. You're not going to produce 15% annualized returns going forward with no risk or low risk. Anyone who tells you that is probably, you know, kind of a shady character.
So, you know, but you mentioned, Russ, there could be another crisis, and you know that you need to be able to, you know, sit through that. But if you are going to see that volatility, are there certain types of stocks, certain categories of stocks you think are going to do better, or does it make sense just to buy the index and kind of hold on to that?
Well, I'll let the stock guys take the stock part, but I'll take on a fund part. I think there are some nice, more conservative funds that will take you down to a little less risk, but also still have some decent returns. I think of allocation funds like FPA Crescent, FPA CX, run by Steve Romick, who's a very good capital preservation-oriented manager. I think of PIMCO All Asset, PASDX, run by Rob Arnott. He's doing a very broad allocation, but again with some conservative elements to that. And I think if a regular stock fund is a little too volatile for you, maybe some of these allocation funds can take it down a notch so that you have less extremes and you can stay invested.
What about on the stock side? I know we talk a lot about moats. Is that something that's relevant here?
Yeah, I think definitely focusing on quality and focusing again on intrinsic value. I think having the confidence to stick with your investment strategy through a market where everyone else is panicking largely revolves around your temperament, the way that you're approaching stocks in general. If you're thinking like an owner and you have a very long-term perspective and you're worried about, what is this company going to be earning 10 and 20 years from now, then you don't need to worry so much about what the market tells you it's worth today. You can just sort of stick to your guns and wait until the market comes around. We always use the analogy of the voting machine versus the weighing machine. In the short term, the market is a voting machine. Stocks go up or down based on their current popularity and what investors think of them. But in the long run, it's still a weighing machine. The value of a company and its ability to generate cash flows is what matters for what the stock's going to do over the long run.
Now, we have a user question about a specific wide-moat stock, Western Union. They're asking, is that as good as it looks? Is there anything that they should, be thinking about on that name?
Sure. So that's always a tough question. We own Western Union in my hair portfolio, and it's actually one of only 2 or so 5-star wide-moat stocks out there right now. My focus is increasingly, though, on the moat trend rating. So this is a rating that we have that indicates whether a company's competitive position is strengthening over time, staying the same, or weakening. And in Western Union's case, we think that the economic moat is actually getting narrower over time as various competitive threats, mobile payments, that sort of thing, increasingly emerge. So the margin of safety looks pretty good in Western Union. It's trading at a low price to fair value ratio, and it does carry our 5-star rating. I'm okay holding it in the hair, but I'm not really looking to add to it unless I can get comfortable that the economic moat is going to last over the long run, that these competitive threats are under control.
Sam, we have a question from Richard who asked, what do you think about low volatility ETFs? That is a strategy, if you're looking to maybe, reduce some of the ups and downs.
Yeah, so I love low volatility ETFs. I've been a proponent of them since they were first launched. So basically, low volatility ETFs, for those who are not familiar with them, basically try to pick stocks with the lowest volatilities. And it turns out that historically, if you applied those strategies across time and across various markets, so emerging markets, the UK, Europe, whatever, you would have had similar returns to the broad market, but clearly with lower volatility. So it seems like the market tends to overpay systematically because of human nature, high volatility speculative stocks. So once you just excise those stocks out of the market, you'll get something like the market, but with tamped down risk. So my favorite low volatility ETFs for the US, PowerShares, S&P 500 low volatility, SPLV, it yields about 3%. Not bad, but it shouldn't be bought because it has a high yield. And it also has a 25 basis point expense ratio. Internationally, the iShares MSCI minimum volatility ETFs are also very compelling. So there's iShares MSCI Emerging Markets Minimum Volatility, EEMV, only charges about 25 basis points. And that's a very, very low fee for an emerging market strategy. It has a slightly higher yield than the broad emerging markets ETFs. Not right now, because there are some weird quirks when an ETF first launches and it grows large in size. The trailing 12-month cash distributions on that ETF might be a little understated. So if you actually drill down and look at the underlying holdings, yields about 3.2%. And whereas the broad emerging markets yield about 2.7%. So you're getting a much higher quality set of slightly higher dividend-paying stocks with EEMV. And then finally, to round out our global low volatility strategy, it's the iShares MSCI EFA minimum volatility, EFAV. This one charges about 20 basis points, and it applies the same strategy to EFA stocks. So that is Japan, Europe, Australia. And so if you own a portfolio of low volatility ETFs, what you can do is you can actually slice down a little bit, not much, your bond allocation. So you can actually effectively expand your equity allocation without actually increasing your portfolio volatility that much. So I think it's a very good way to slightly tilt your portfolio to a more equity-oriented stance.
That's great. And we have some questions that there will be a transcript of this session with all of these tickers later. So if you can't quite get them down as fast as we're going through them, don't worry. Those will be there. Now, a viewer wants to know if it makes sense to set up a stop-loss order on investment to say, hey, if this falls more than 20%, I just want to get out. Is that feasible, in order to maybe make you sleep a little bit better at night, or is it just going to give you more nightmares?
I've been getting this question for years. I always go back to, the greats, whether it's Ben Graham or in this case Peter Lynch. I think in One Up on Wall Street, I said, you show me a portfolio with 5 to 10% downside stop loss orders, I'll show you a portfolio that will lose 5 to 10% every year. I just don't think that that's the right way to go about it. I think that, again, it gets so much back to temperament, understanding what you have in mind for your portfolio, understanding the risk-reward trade-offs, and focusing on intrinsic value, and in my case, focusing on dividends. You've got the opportunity in a rough market, to continue holding a stock like a Johnson & Johnson that's not going to cut its dividend, is going to continue to raise its dividend. It's reminding you and paying you every quarter, we're still in business. The stock price is going down, but it'll come back. I much prefer to just say, I'm not going to spend any time or waste any opportunities or waste any capital trying to tamp down on minimal volatility. Instead, I'll say if the income is what is the priority, then I will focus on the income and the stability of income in my portfolio, and I can let the stock market do its thing up and down because it's going to happen. I don't think there's any effective way to try to completely hedge that out. And stop loss orders, I think you'll lose many more opportunities than you'll save in terms of capital losses.
So adding on to that, the market day to day tends to be very volatile. So there are whipsaws in a lot of stock prices. So you may remember the flash crash in which a whole bunch of stocks just suddenly plummeted in 15 minutes. And there are, little micro flash crashes that happen all the time, not as severe, but there are times when stock prices suddenly go down really, really quickly because someone just put in a massive order and then it bounces right back up. So some of that might actually be due to high frequency hedge funds that are exploiting stale stop loss orders. So I would not try to use a stop loss strategy. If anything sounds very simple and it sounds like it's going to produce risk-free returns or really high returns, I'm going to get all the returns of the market or most of the returns of the market, but I'm going to hedge at all the downside with some stop loss orders. If it sounds too good to be true, it is too good to be true. So there are all kinds of strategies that investors like to do that sound intuitive. One is dividend capture strategy. So just buy a stock, right before it pays a dividend, and then you sell out, you collect the dividend. Well, the stock price goes right down to adjust for that dividend. So a lot of these strategies that sound good, that anyone could think of, they don't work.
Yeah, and they don't go away either. Dividend capture, I've been asked about this regularly for 8 years now at the helm of DividendInvestor, and explain it. You only get the benefit of receiving that dividend if you've owned the stock long enough for the company to have earned the money to pay it to you. So you need to back away from that. And now that I'm thinking about it, I think what I mentioned earlier about the Peter Lynch reference is he may have been talking about put protection and buying puts to insure your portfolio against declines, but it's the same thing. You're spending a lot of money to protect against a risk that if you can manage it, you should just absorb it and save yourself the trouble.
So both of these are really saying there's no free lunch.
There is no free lunch. There is no free lunch, not dividend capture, not stop loss, not option protection. I mean, I think you make a decision to buy or sell based on the relative opportunities you have, the strength of the company. You don't outsource that to the whims of the market. Whipsawed is the perfect word for it.
So one of our viewers is actually looking to take on more risks. So unlike some of the investors we were talking about earlier, maybe we're trying to be more conservative, looking for more core. They're looking for more of that explorer part of their portfolio. What are some good picks, maybe on the fund side of more concentrated portfolios, maybe some riskier equity ideas?
Sure. Let's see. One of the first funds that came to mind is not that concentrated, but I like Prime Cap Odyssey Aggressive Growth. POAGX is just a very good, well-run, fairly aggressive growth fund. The Prime Cap just has outstanding managers who really look at the fundamentals. If you want to get focused, a fund like Oakmark Global, I think, is an outstanding focused portfolio of world stocks where the manager, Clyde McGregor, really has a lot of flexibility to buy just about anything he wants.
Matt, is there anything from maybe your hair portfolio that you think looks interesting right now?
Probably the riskiest name in the hair, but also a name that I think there's a lot of opportunity in, would be Baidu. Baidu, ticker BIDU, is basically the Google of China. There's an enormous number of risks that come with investing in China ever. Really, this is probably the only Chinese company that I would consider for my portfolio. But it's a very high-quality company, $30 billion or so market cap, audited by PricewaterhouseCoopers. But most importantly, it's trading at about 16 times this year's earnings, but growing 40% a year. And over the last several years, they've been growing 100% a year. If Google is any indication, I think that it has a very long way to go in terms of the opportunity of online search. There are a lot of secular trends working in its favor, one being the growth of China's economy overall, but also a secular shift in advertising away from traditional media into online media, and then even within online, shifts away from portal-type sites like Yahoo and towards search sites where you can have the most effective advertising. So a relatively risky name. It's only a narrow moat company, but the price to fair value looks very attractive, and the long-term growth story looks extremely attractive.
So let's take a look at global investing then. We looked at this, Chinese stock, and does it make sense to look at other, Chinese investments? What part of your portfolio, how much of your stock allocation should be outside of the U.S.?
So in my portfolio, Baidu is the only emerging markets company. We're very U.S.-centric. I still think the U.S. is the greatest wealth creator that's ever been imagined, really. U.S. businesses have been creating value for 200 years. We have one of the more favorable regulatory environments. We have more favorable demographics than most of Europe, for example. So there's less risk in the U.S., and I still like the U.S. for the vast majority of my portfolio. The best way to gain international exposure, I think, is really through multinational companies that have exposure to all of these regions. So some names that come to mind would be a lot of big pharma. A lot of those companies aren't necessarily cheap, but we own Pfizer, Novartis, which is based in Europe, but really is just a global pharmaceutical company, Johnson & Johnson, MasterCard, a name that looks fully valued also, but gets more than 60% of its revenue from outside the U.S., and that's really my favorite way to play international markets. One more name I'll give you is Potash Corp of Saskatchewan. This is a good play on international or emerging markets without taking all of the risks that come with actually investing in those emerging markets. Assuming China and India continue to grow in the way that they have been, the populations are going to want to eat an increasing percentage of meat, fruits, and vegetables, and those take a lot of fertilizer to grow. So Potash Corp is one good way to get exposure there.
I would say anywhere, I have a little different take. I would say anywhere from 30 to 70% of your equity stake can be overseas. They've done surveys, and every single country, people think that their market is safer than everyone else's, which collectively is completely irrational. And I think really there's not that much difference. As Matt points out, a big multinational here or Europe or Japan, there's not that much difference. But I do think there is some diversification and currency value in going outside the U.S. So I think you can really have a pretty wide range.
What are some of your favorite global stock funds?
I like Dodge & Cox Global. I like Oakmark Global. And then there's some global allocation funds, like I mentioned PIMCO All Asset. So I do like global and allocation and world stock funds because the managers have a lot of flexibility to go wherever the best values are.
Sam, Russ mentioned that a big global company in Europe is not that different from a big global company in the U.S. I know a lot of ETF providers have tried to then create ETFs that get into smaller cap names in emerging markets and elsewhere. Can you talk to us a little bit about those ETFs and maybe the advisability of using them these days?
Okay, so historically, across almost all markets, smaller cap companies have outperformed larger cap companies, and there's a name for it. It's called the small cap premium. So that's one, and ETFs are a great way to access this small cap premium because you're doing it with a very low cost, widely diversified product. So one of my favorite small cap international funds right now is WisdomTree Emerging Markets Small Cap Dividend ETF, DGS. And what this does is this looks at the highest yielding small cap stocks in emerging markets. And it weights them by their share of dividends to be paid over the next year. And so what you're doing is you're buying a strategy that every year trades against the market. So it applies a mechanical contrarian dividend-oriented strategy on these smaller emerging market stocks. I don't recommend a big allocation to this fund because it's fairly volatile, but I think that if you hold a small slice of it to complement your pre-existing emerging markets allocation, it could add a little bit of extra return.
Yeah, I'd add to that and say I think dividends are a great tool to go and get international exposure, especially in the emerging markets where the legal protections, the accounting rules and whatnot may be a little dodgier. But I think if you're looking to have a portfolio here as a U.S. investor and generate a lot of dollar income, you go overseas and you take on some currency risk. You may deal with some withholding taxes. That's one reason I like a Johnson & Johnson, but I'm not as big of a fan of Novartis because in Switzerland they withhold a pretty large withholding tax against U.S. investors. You can recoup some of it in a taxable account, but not a tax-deferred account like an IRA. So there's some practical constraints. So I really, I tend to be more U.S.-centric, but there are a couple of companies in the U.K., Vodafone and Royal Dutch Shell, both of them certainly global companies in terms of their exposure, but out of the UK that I think are some of the more bargain names for yield seekers right now.
So we had a viewer question about the Japanese economy. For a while it was almost a joke that a fund manager could outperform the index by just not holding Japan. Are those days behind us? Are there attractive? Have valuations finally become attractive enough there?
Yeah, it's interesting. Dennis Statman of BlackRock says, yes, now is the time to get into Japan. And then you see someone like Longleaf, and they're actually backing out of Japan because they got burned by names like Olympus, where the shareholder, where you can have some issues, and it's clear that shareholder rights are not as strong there. So it really, on a valuation basis, a lot of people say yes. On a shareholder rights basis, people are still a little wary.
To add on to that, Japan has had problems for a long time because their culture does not emphasize shareholder returns. Companies and CEOs see themselves as servants to the greater society, to the government, to their workers, to their suppliers. Their shareholders are just, one of many, many stakeholders. And so the return on equity in Japan has historically been fairly low. And not only that, but a lot of Japanese companies for a very long time, over 20 years, had hidden debts that they accumulated. So during the Japanese real estate bubble, which was truly massive, it completely outstripped the U.S. Bubble in terms of the price appreciation in commercial properties. A lot of Japanese companies decided that they're going to turn into real estate hedge funds. So they borrowed a lot of money and invested in these commercial properties. And when prices collapsed, what these Japanese companies did was they didn't mark down their assets, because if they did, virtually every single large cap Japanese company would have been insolvent and should have gone through bankruptcy and whatnot. So what the regulators and what Japanese companies did was they slowly whittled that away at that. So Olympus was actually a case in which they were using dodgy accounting and using their organized crime connections to sort of write down the debts that they had accumulated. So they were writing down debts that they accumulated 20 years ago. So that's why Japan, this massive debt overhang that a lot of investors didn't understand, combined with a very shareholder-unfriendly society that didn't emphasize returns, has managed to produce consistently low returns. But now people think, finally, that the debt loads of a lot of these Japanese companies are finally gone. So a lot of these hidden debts are mostly paid down. So, so you can't look at Japanese returns, 10, 20 years ago past and project that out into the future. That said, there's still the case that your return on equity is still probably going to be very low because cultures do not change. 20 years from now, Japan will still probably be less shareholder friendly than the US is right now. But I would say that Japan right now is about fairly valued. So it's not outstandingly cheap. Full disclosure, I'm actually overweight Japanese equities at this moment.
So we have a few minutes left so that we'd maybe try to tackle a few different topics. The first being alternatives. We had a question about buying gold and silver and other precious metals in today's market. What's the advisability of that? Well,
gold can be thought of as a currency, a non-yielding currency, and that's how it's being priced in the market today. As a non-yielding currency, you can't really expect to make a lot of money on it. The only reason why you would invest in it is because you can sell it to someone who's more scared later on, as Warren Buffett put it. So long term, gold and silver is not going to do you any good. 20 years from now, I fully expect I'd put a decent amount of money that you would probably be better off in just large cap, high quality stocks. That said, gold has diversification properties. So if you buy gold and silver with the expectation that you're going to lose money over the long run, but you're willing to pay up, you're willing to lose that money for perhaps the Mad Max scenario that might unfold, making it worthwhile, then yes, gold and silver is a decent bet. And even though I sound dismissive of gold, I do own a little bit of gold in my portfolio. So I just want to get that out.
I would just add to that, I think the key point is the difference between investing and speculating. And any investment in gold is really a speculation about what people are going to value that gold at in the future. People think of it as being the ultimate good with intrinsic value, but I'd really say it's the opposite. It doesn't generate any cash flow. It has no intrinsic value. The only value of gold is what somebody else is willing to accept for it down the road.
Matt, we had a question that I think you'll probably be able to tackle about tech stocks, particularly Facebook and LinkedIn in particular. Do you think those are attractive right now? I know you just trimmed your position in Facebook a bit in your portfolios.
Sure. We're overweight tech in general, and I think there are a number of opportunities. I already mentioned Baidu as one. Facebook, I think, is trading at a decent discount to our fair value estimate, but on the other hand, there's a tremendous amount of growth that's baked into that fair value estimate, and the stock is trading at a very rich multiple of earnings. I'm not sure what the latest multiple was, but something in the 45 to 50 range, I believe. So the stock is expecting a lot of growth, and we're expecting a lot of growth, but that kind of story just gets me nervous that something could happen and the growth story could not play out quite as much as we expect. The difference with a Baidu is that you're getting a similar level of growth, but you're not paying for it. You're only paying 16 times earnings instead of 45 plus times earnings. Some other names that I like right now in tech, Oracle is a company that was off quite a bit earlier this week. It seems like it's partly a one-quarter issue with their sales staff. There's certainly some concerns out there that they're getting disrupted by cloud computing and cloud-based competitors. But so far, analysts think that the wide moat is stable, that the competitive threats are under control, and that Oracle is going to be able to navigate its way into the cloud in this new environment.
We had a question from Kim, who asked that the market is now at an all-time high. She regrets not selling stocks prior to or after the last time we hit the high in 2007. Should she be thinking about trimming positions? How do you know when to trim some of your winners?
Well, I think one simple thing is simply rebalancing. If you've got a plan that says, I want to be 60% equity, and the market rallies, now you're at 65, well, on an annual or twice a year, whatever basis, you can sell some of that in. I don't think simply hitting the high is enough information to tell you that the market is overpriced. I think you need a little more than that. And I think at a minimum, just simply following that rebalancing, sticking to your plan can help you a lot.
It's not a high in real terms either. The record from early 2000 is probably going to stand for a while if you adjust it for inflation. And I get the question, it came up earlier, it's time to just throw all my money back in the markets. That is an almost impossible question to answer because nobody's got the operating crystal ball. But Stocks, I think, are much more attractively priced than bonds. Cash is being trashed with no return as inflation continues to eat away from it. So I think in this kind of environment, you say, yeah, new highs, that's just an interesting little tidbit of news, but there's no reason that the market can't continue to run up to much farther from here. And even if you wanted to wait for a pullback, there are going to be pullbacks and corrections, I'm sure even some this year, but there's no guarantee the market goes to some point that's lower than where it is at today. So I think you follow a plan, you stick with a plan. If you want to get back into the market, don't let new highs necessarily put you in or out. Step back, make that decision about what you need your money to do over the long run and the risks you're willing to tolerate while taking it.
So it comes back to that discipline. How about the basic materials sector? Any good opportunities there?
So that's another sector that we have an outsized exposure to, especially in the hair. Some names that come to mind would be Compass Minerals. It's a very high-quality company. They mine salt in the Great Lakes region. They've been underperforming as the last 2 years. Anybody that's in the Chicago area knows there hasn't been a whole lot of snowfall, which means that inventories of salt have stayed there, and municipalities haven't had to buy a lot of new salt. They also have some exposure to potash, which is a similar story that I was talking about with Potash Corp, another name that I like in the basic materials industry. One more name that comes to mind would be Cloud Peak. This is pretty much one of the lowest cost coal miners in the world. Right now, coal is not a great place to be, as natural gas prices have been very low and utilities have been diverting their generation capacity away from coal and towards natural gas. But we think even that at current natural gas prices, the prices that the Cloud Peak is getting for its coal are unsustainably low because of some inventory overhang. As utilities work through that overhang, and we still can't get by generating enough electricity or all the electricity that we need without burning some coal, no matter how dirty it is, the prices should rebound, and that would be reflected in Cloud Peak.
That's about all the time we have today, but I want to thank Sam, Matt, Russ, and Josh for joining me today. Great picks.
You're welcome.
Thanks for having us.
Jeremy.